Hi, everyone. One of the smartest investors on Wall Street are moving their money right now while everyone else celebrates new highs. There's a warning signal that correctly predicted 7 out of the last 8 recessions. This signal just screamed danger for 16 months straight, the longest in history, yet most investors are completely ignoring it. The yield curve inversion. From July 2022 to November 2023, short-term rates stayed higher than long-term rates for 783 days. That's insane. It's like your bank charging more for a 6-month loan than a 30-year mortgage. When this happens, trouble usually follows. Here's what scares smart money. Since 1968, the yield curve inverted before 7 out of 8 recessions, only wrong once in 1966. That's 87.5% accuracy, better than any expert. But this recent inversion was deeper and longer than the one before 2008. Right now you're thinking, but my portfolio looks great. Stocks keep going up. That's exactly what people said in 1928 before the Great Depression. That's what they said in 2006 before the housing crash. History repeats, and we are seeing the same pattern. The pattern never changes. Warning appears. Everyone ignores it. Stocks even rally for a while, then everything crashes. In 1928, stocks rallied 2 years before falling 89%. In 2006, market hit new highs for 18 months before collapsing. Sound familiar? Here's the concerning part. We're 12 months past the inversion ending. Normal time between curve fixing and recession, 6 to 24 months. 1928 crash hit after 17 months. 2006 crisis after 16 months. If history repeats, we're in a critical window right now. Your portfolio is at risk. Most of you own growth stocks, tech stocks, AI plays. Your portfolio was built for yesterday's market, but when trouble comes, growth stocks fall hardest. This is where SCHD becomes your safety net. The Schwab US Dividend Equity ETF pays you cash while protecting you. SCHD owns 103 carefully picked dividend stocks yielding 3.88%. That's more than triple the S&P 500's 1.14% yield. But SCHD doesn't just buy any high-paying stock. It uses 4 tough tests: cash flow versus debt, return on equity, dividend yield, and 5-year dividend growth. What does this mean? You own companies that keep paying dividends even during bad times. No traps, no fake yields, just strong businesses that make real money. Since 2013, SCHD returned 253% total. Real wealth building returns with safety. Better yet, SCHD grew dividends 10.4% yearly for a decade. While S&P 500 companies cut dividends in 2022, SCHD companies kept paying and raising. Here's your playbook. Beginners, put 30% to 50% into SCHD now. Protection while you grow. Intermediate, 60% SCHD, 40% strong stocks like Cisco, Amgen, AbbVie, more dividend income. Advanced, 70% SCHD, 20% treasury bonds, 10% cash for buying dips. The pro strategy. Why SCHD? Sector mix built for defense, 20% energy, 19% consumer defensive, 16% healthcare. Compare that to the S&P 500's heavy tech weight. When tech crashes, the S&P crashes with it. In 2022, SCHD fell only 3.3%, while NASDAQ dropped 33% same year. One protected money, one destroyed it. That's planning versus hoping. The warning signs are flashing. Corporate bankruptcies rising, credit card late payments at 2009 crisis levels, leading economic index showing weakness. These aren't small warnings, these are sirens. Here's what news won't tell you. Good headline numbers hide ugly truth underneath. Full-time jobs disappearing, part-time jobs growing. People work 2 or 3 jobs for rent. This exact pattern appeared before every crisis. When headlines look good, but data's bad, get defensive. SCHD protects you because those 4 tests ensure you own businesses with real profits and manageable debt. You're investing in survivors, not gambling on hype. Top holdings tell everything. Cisco Systems, Amgen, AbbVie, Lockheed Martin, Merck, not startups burning cash. Giant companies making billions quarterly. When markets crash, these keep paying dividends. When startups fire workers, these buy back stock. Everyone thinks it's different. 1929, technology made crashes impossible. 2006, house prices only go up. Today, AI saves everything. Most dangerous fact nobody discusses, 73% of pro-investors think we'll avoid recession through 2026. Highest everything's fine reading since 2007, right before the financial collapse. Proof the crowd's wrong. Money's leaving SCHD as investors chase growth at exactly the wrong time. When regular investors chase last year's winners, smart money does the opposite. 5 critical facts. First, yield curve inverted 783 days, longest in U.S. history. Bond market screaming danger. Second, inversions over 3 months are right 73% of the time versus 45% for shorter ones. Ours lasted 16 months. Third, SCHD grew dividends 10.4% yearly for a decade. While tech fired workers in 2022-2023, SCHD companies raised dividends. Fourth, SCHD fee is 0.06%, 6 cents per $100. On $100,000, you pay $60 yearly while earning $3,880 in dividends. Fifth, since 2013, SCHD beat other dividend funds by 37 percentage points. Better stock picking. Secret weapon? SCHD owns 15% less tech than S&P 500, more energy, healthcare, consumer staples. These sectors survive slowdowns. When people cut spending, they still need healthcare, utilities, food. SCHD owns these providers. 3 moves today. Move 1, put 30% to 50% into SCHD now. Risk management, not market timing. You're getting nearly 4% yield either way. Move 2, automatic monthly buys for 12 months. $800 to $1,000 monthly captures any drops. Regular buying beats timing. Move 3, start 20% SCHD. Markets up, move winners into SCHD. Markets down, increase to 50%. Build position either way. Time to act. Inversions lead to slowdowns 6 to 24 months later. Our inversion ended November 2023. We're 12 months out. 1928 crash after 17 months. 2006 crisis after 16. History has a way of repeating. Proof big investors know something. SCHD got $9.46 billion in 1 year, $25 billion in 3 years. Smart money's moving now. My prediction? By the end of 2026, SCHD will beat the S&P 500 by at least 10 percentage points. Winners switch from growth to quality dividends as economy slows. Reading patterns, not guessing. In 2022, SCHD fell 3.3%. NASDAQ dropped 33%. 30-point gap. Difference between sleeping well and panic selling. Opportunities here because everyone chases last year's winners. When rotation happens, and it always does, it's fast and brutal. Position before the crowd or spend years recovering. Why this works, no matter what. Economy grows, you collect 3.88% dividends, growing at 10% yearly. Growth slows, dividend stocks win as money moves to safety. Recession hits, you own businesses with strong balance sheets keeping dividends while competitors cut. This isn't market timing. This is smart positioning based on risk management, patterns, and understanding markets. The yield curve warning, longest inversion in history. Stress signs under good headlines, not disaster promises. Reasons to protect your portfolio. Don't let good times convince you warnings don't matter. Don't let recent wins convince you this time's different. Most successful investors build wealth positioning ahead of big changes. This is one of those moments. Yield curve doesn't lie. History repeats. Right now, every pattern says quality, income, defense, beat, momentum chasing. Your choice. Protect money or hope nothing bad happens. SCHD gives you both, growth potential with dividend income and defensive positioning. While others panic for the next crash, you'll collect dividends and buy at discounts. Remember, not financial advice, not your advisor, education only. Your choices depend on your situation. Risk level, goals. But if this opened your eyes to risks you didn't see, subscribe so you don't miss future insights on protecting and growing wealth. Clock's ticking, history is repeating, smart money's moving. The question is, will you act before the crowd or react with them? Smash that like button, share with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.